Very good evening, everybody. Welcome to the live webinar on spread trading fundamentals, a practical approach to commodity spreads. I'm Ming Hui from Phillip Nova, and speaking to us tonight will be Senior Research Analyst from Mint Finance, Mr. Pranay Yadav. Before I pass the time to him, I would like to inform everyone that if you have any questions throughout the course of the webinar, you can send them in via the question box and we will get to them at the Q&A session towards the end. And now, without further ado, over to you, Pranay.
Thank you, Minghui, and thank you everyone for joining us today. I know it's not easy to join us this late in the day, but I'm hoping that through today's seminar, I'm able to provide you enough content, enough actionable information that you're able to take this and actually start to execute trades on the back of this. Uh, I'd like to start with a brief overview on this series because what we're going through today, the seminar, is actually the first of a two-part series. The second part of the series will be a month from now in June, and that's where we'll be covering a little more on the practical side of things. We'll be covering how to actually execute the spread trades, especially through Phillip Nova platforms. For today, we'll be focusing a little bit more on theory. We'll be going over what is a spread trade, how do they work, how does the payoff work, when to use spread trades versus when to avoid them. So today will be a bit more of a theoretical overview. If you're interested in a bit of a practical overview, we'll be covering that through an in-person session about a month from now, and the details should follow in an email shortly after as well. With that brief intro, I'll get started. And I'll start with an introduction to Mint Finance, and I'll keep this brief as well. So, Mint Finance is a Singapore based boutique consulting and research firm. We provide advisory services covering risk assets, risk management, and we also consult in capital markets. Our clients include exchanges, hedge funds, family offices, sell side brokers, and commodity market participants. We also publish research, which blends fundamental analysis with technical and quant insights. If you're interested in exploring some of our research pieces, you can scan the QR code on the screen to go to our trading view page, where we publish a lot of our research for free. It's publicly available, and all you need is a trading view account. Before we get started, I will go through a short disclaimer, and it's just to clear up some of the content we'll be covering today. Now, it's pretty boilerplate, but the material today has been published for general education and circulation only. Any advice should be sought from a financial advisor regarding the suitability of investment or a risk management product. And past performance is, of course, not indicative of future performance. This is important because we'll be going through a few examples through the course of the presentation today. Finally, all examples used in this workshop are hypothetical and they're for explanation purposes only. With that, let's get started. Let's start with an introduction to spread trading. What are spreads and how are they traded? I'd like to start with an example above all else. So, spread trades are a combination of two different futures trades in the same position. They offer a relative value comparison between different derivatives, which means these could be different expiries, different assets, or they could be different grades. And relative value just means how one leg performs relative to the other, which means is one leg outperforming the other or is one leg underperforming the other? With clarity on a few of those terms, let's jump into the example. And the example I like to start with is something that may be relatable to some of you. It's the gold silver ratio. Now, this is a ratio that traders have been using for a long time. And it's been getting more and more popular as of recent times because of the huge run up that we've seen in silver prices last year and precious metal prices as a whole over the last 2 to 3 years. Now, one of the key factors that I want to highlight and that you can also see on screen here is that spread movements are actually independent of the price directions in the underlying. What does that mean, right? That just means one thing. What we can clearly see on screen here is that both gold prices and silver prices have actually gone up considerably over the past 2 years. Silver prices are up 176%, gold prices up 77%. Despite that, the gold to silver ratio is actually down 35%. And that's crucial, right? It's because spread movements are actually independent of what any of one of the legs are actually doing. It doesn't actually depend on one of the legs at all. It doesn't depend on whether gold prices are rising or whether silver prices are rising. All it depends on is whether gold prices are outperforming silver prices. As a result of that, spread movements can actually be uncorrelated even for correlated assets. Now, the gold silver ratio is actually negatively correlated most of the time over the past year or so. And that's the blue line that you see on the bottom here. It's interesting because the other line that you see here is the correlation between gold and silver. As you can see, that's highly positive. What that means is that when gold prices rise, silver prices rising is actually a pretty predictable scenario. Despite that, the gold silver ratio actually behaves completely differently. It actually has a negative correlation most of the time, and that correlation actually breaks pretty frequently. You can see in November 2025, and then again in January and February 2026, that correlation breaks and it starts to turn positive once again. But that put that all together, what that means is the spread movements can be uncorrelated even for correlated assets like gold and silver prices. That means that when you're expressing a view on the gold silver spread, it can be a very unique position, especially when you compare it to gold and silver individually. With that, I'd like to delve into a bit of an overview in terms of categories of what spread trades that actually exist. First of all, there are calendar spreads. These are spreads that consist of positions in the same asset but different expiries. For example, these could be a position consisting of a position long December futures and short June futures, both of them in the same underlying of natural gas. Second type of spread trade could be an intercommodity spread. Now, in intercommodity spread, you're not on the same futures contract anymore. You're not on the same underlying asset anymore. You're in fact getting across asset lines. You're crossing across assets. These could be related but distinct assets. One example we've already covered over the last couple of slides, gold versus silver, right? Another couple of examples could be substitutable crops. For instance, wheat versus corn. These are common intercommodity spreads as well. Another type of spread trade, another family of spread trades is cross index spreads. This provides exposure to one equity index versus another index. So this could be how the S&P 500 performs relative to the Nasdaq 100, or how the S&P 500 performs relative to the Russell 2000. Now, different equity indices, different quote unquote assets, and a different family of spread trades. Another type of spread trades are location spreads. These are the same commodities across different delivery location. For instance, in this case, I've added an example of WTI and Brent. Both are both are delivering crude oil, just that they're delivering them at different locations. As a result of that, WTI becomes more of a US benchmark and Brent becomes much more of a global benchmark. The spread between the two can offer a location spread, and that can be a very useful quantity to track if you're looking to get information on how a specific asset's locational availability is trending, which means how much of an asset, how much of crude oil is actually available in the US versus internationally. And location spreads are really important, especially during things like supply shocks, similar to what we are seeing right now. Process spreads are spreads that represent input versus output relationships. So in this case, you can consider them as the output spread, the example I've added here, the output of crude oil to gasoline and heating oil. Now, crude oil is refined to produce gasoline and heating oil. As a result, the output quantities are clearly linked to the input quantities. Nevertheless, they can be distinct, which means that gasoline and heating oil prices can move independent of the input quantity of crude oil prices. And the process spread can help you get a handle on how the input and output relationships are actually changing, how the refinery margins actually shifting. The last family of trade, quality spreads, can represent different grades of the same commodity. There are, of course, other types of trades that fall under the same family of trade, including cross currency asset spreads. These could be spreads that are expressing the same view across assets that are quoted in different currencies. One may be in euros, the other may be in dollars, but the same asset, right? The underlying here could be the same asset, but the currency quoted may be different. So these are different types of spreads, but they form and they all fall under this broader category of spread trade. They all fall under this broader umbrella that I've highlighted here. With a bit of that overview on what spread trades actually are and how what families of spread trades actually look like, I'd like to get into how spread trades pay off. Because for a trader, what's important above all else is the mechanics of the trade itself. How does the profit trade or how does the profit payoff actually work, right? And that's what I'll delve into over the next few slides. Let's start with a bit of an overview on the mechanics of spread trading. As I already highlighted, a spread trade actually consists of buying one contract and selling another contract simultaneously, which means the overall position actually consists of multiple legs. One leg you're long, the other leg you're short. Now, in order to gain exposure to true relative value, the notional value of the two legs actually needs to be balanced. These are a few confusing terms for beginners, so I'll take a bit of an aside here to just define what these terms mean. Let's start with what notional value actually means. Notional value is just the value that you're getting exposure to. Now, when you're going long on a gold futures contract, in this case, the micro CME gold futures, you're getting exposure to 10 ounces of gold per CME micro gold contract, right? You're getting exposure to 10 ounces per contract. With gold prices around about $4,700 an ounce as of today, that gives you a notional value of 47,000. Hoping that gives you a bit of a clear picture on what notional value is. It's essentially just what you have exposure to when you're going long on micro gold. When you're going long on micro gold, you're going long on $47,000 worth of gold prices. Now, let's get into what does it mean for notional values to be balanced. Now, as I said, balancing notional values is really important. It ensures that you prevent unintended directional exposure in the overall spread position. To demonstrate this, I'll just give a bit of an example that consists of the gold and silver spread that we were looking at previously. Now, for gold, which is the long position in the gold silver ratio, we've already looked at what the notional prices represent, right? It's $47,000. That's just what we calculated right now. It's 10 ounces times $4,700 per ounce, $47,000. Now, the notional for one contract of CME micro silver actually consists of a different quantity altogether. CME micro silver offers exposure to 1,000 ounces of silver, with silver trading at $86 as of today. That gives you exposure to $86,000. Now, what's crucial here is that the two values actually differ. Long CME micro gold futures is providing you exposure to $47,000 worth of gold, whereas a short CME micro silver position is actually providing you exposure to $86,000 of silver. Since those are different, What you need to ensure is that both of those are balanced. Because if you're just going long one contract of micro gold versus one contract of micro silver, clearly you would have much more exposure to the silver side of the trade. That would represent a trade that's not exactly a true spread anymore. In order for it to be a true spread, you need to balance the two legs. What that means is that roughly, in order to balance these two spreads, what you'll need is two contracts of micro gold and one contract of micro silver. Still doesn't perfectly balance it, but it gets you a lot closer. And the closer and closer you get to matching these notional values across both of your legs, the better exposure you have to the underlying spread as opposed to the underlying quantities themselves. Because what's important here is to step back a little bit and realize that when you're trying to get exposure to a spread, what you want to avoid is explicit exposure to any one of the two underlyings. The closer you can match each of these two, the better your exposure to the underlying spread is. Now, spreads can be quoted both as a single price differential or as a ratio. It can depend basically based on what type of quantity you're considering. Brent and WTI, which, as I highlighted, are different oil benchmarks, they're often traded as a differential between one and the other, which means Brent minus WTI, which as of today is about $10. Now, spreads can also be represented as a ratio. Here, I've highlighted gold versus silver as an example. Gold prices over silver prices gives you a ratio about 55. And these are just two different ways of representing the same underlying spread quantity. It's not a different quantity, it's just a different notation to represent the same thing. Now, a crucial point that I'd like to bring up right now and that we'll dive into later in the presentation is that exchanges often provide lower margin requirements to spread as compared to outright positions. That means outright long shorts in independent quantities. And that's due to the reduced risk profile. Because gold and silver are very highly correlated, this is a relationship that we saw about two slides ago, right? Because they're highly correlated, the exchanges understand that the position that consists of a spread between the two actually consists of a reduced risk profile. They pass on some of that reduced risk profile to you in the form of lower margin requirements. With a bit of that brief overview, I'll get into profit conditions. Because for traders, it's actually very important to understand how does a position's payoff actually work. Because a spread position consists of multiple legs within the same position, it's not as straightforward as just a long versus short. For this example, I'll provide an overview of how a long WTI and a short Brent spread pays off. So let's consider the scenario of WTI prices rising and Brent prices falling. Now, I'll start with kind of jumping a little bit back, right? In this position, we were long WTI, we were short Brent. If WTI prices have risen and Brent prices have fallen, what that's telling us is that both of the legs are profitable. And clearly, in such a scenario, the spread would rise, which means that if you're long the WTI Brent spread, in such a situation where WTI prices rise and Brent prices fall, your spread position would benefit. That means the spread prices would obviously rise. This is one of the most trivial scenarios wherein both sides of the position, both legs of the position are actually benefiting. But that's not always what you'll see happen. For instance, the next scenario that we'll consider is a scenario wherein both WTI prices and Brent prices are actually rising. Now, in this scenario, what I've written out is that WTI prices are rising more than Brent prices. Now, because WTI prices are rising more than Brent prices, the loss that you make on the short Brent crude position is actually being offset by the much larger profit that you're making on the long WTI crude leg. As a result, your overall spread would actually still rise. That means that if you were long on this spread position, you would still profit in this scenario. Similarly, let's consider a scenario wherein both WTI and Brent prices fall. Now, in this case, the scenario assumes that Brent prices have fallen a lot more than WTI prices. Because of that, the same rationale, let's walk back. The short position in Brent crude is actually paying out a lot more than the long position than what you're losing in the long position in WTI crude. As a result, your net position is actually still rising. That means on a net basis, your spread is still profitable. And this is crucial. What that's telling us is that regardless of whether oil prices as a whole are rising or falling, the spread can benefit or lose, right? So in this case, both WTI and Brent prices were falling, which means majorly oil prices as a whole were declining. Despite that, by executing this position through a spread, we were able to benefit. That means the spread was actually rising despite the fact that oil prices were falling. This is important, right? The next scenario has us at WTI prices remaining flat and Brent prices falling. Now, similar type of payoff here because despite the fact that you make basically nothing on the long WTI leg, the fact that you're making a huge profit on the short Brent leg is actually important because that's paying for your overall spread position. The spread is still rising. Finally, WTI rising while Brent remains flat still leads us to the spread rising. That means that all WTI prices have to do is outperform Brent prices. Let's delve into some of the loss conditions, though, because it's important to cover both sides of the picture, right? Now, it's, as you'll probably understand as I walk through each of the scenarios, these scenarios are basically polar opposites of the scenarios that we saw in the previous slide, which means that in this case, WTI prices are falling, Brent prices are rising. Clearly, in this more straightforward scenario, the spread would fall, right? We were long WTI, we were short Brent crude. Because both of those positions have moved against us, the spread is falling, and a spread position in this case would be loss making. Next type of scenario is WTI prices rise, but they rise less than Brent. And this is, I've added it here to re-emphasize a bit of a nuance that some traders may miss, which is that despite the fact that you were long on one of the legs, which is profitable, you're still losing out as a whole. WTI prices are still underperforming Brent prices. Because they're underperforming, the spread is falling and the spread position is still loss making. And this is really important. What all of these scenarios are telling us as a whole is that what we need to happen is the WTI prices need to outperform Brent crude. That can happen in many different scenarios, but despite the fact that just the fact that WTI prices are rising doesn't offer us a clear cut scenario on the spread outperforming, which means that just because WTI is rising doesn't mean the spread will be profitable. For the spread to be profitable, WTI actually needs to outperform Brent crude. That means that in each of the scenarios wherein it's underperforming, the spread is falling and the spread position is loss making. Let's put a few numbers behind this and shifting gears a little bit to a different example. With numbers, I'm hoping this whole description becomes a lot clearer. For the scenario one, let's assume that gold prices have risen from 4,700 to 5,000. During the same time, silver prices have fallen from 85 to 70. Clearly, both legs in this scenario are profitable. The spread position as a whole is profitable, right? So this is the most trivial of scenarios. The next scenario, though, is less clear because both have fallen, right? Your leg one, wherein you were long gold, even that is loss making. But the fact that silver's short position is offsetting the losses that we made on the gold long means that the spread position as a whole would still rise. And that's happening because silver prices are falling a lot more than gold prices did. Last scenario, gold prices rising and silver prices rising as well. This is what I hope is the most clear cut scenario to emphasize the nuance here. Because just the fact that gold prices are rising does not guarantee that your spread position would actually be profitable. Because in this case, your profits that you make from your long position are offset all more than entirely by the short position losses that you're making on silver. Because silver prices in the scenario have increased from 85 to $100. Because of that, the overall spread that consists of both of these positions would be falling. With that overview in terms of how payoff works, let's get into when is the right time to use spreads and when is perhaps the time to avoid them. Let's start with the advantages of spread trading. The most important advantage is uncorrelated returns. Spread trading can offer uncorrelated returns to underlying asset returns. What that means is, despite the fact that gold prices were rising, the gold silver ratio was falling. That means that by expressing a view on the gold silver ratio, we got an uncorrelated position that was completely unrelated to what was happening in gold prices. This is important for portfolio managers because, as any competent portfolio manager knows, diversification is super important. Diversification allows your overall portfolio to perform well in all types of conditions. That means that regardless of in specific macro scenarios, in specific supply demand scenarios, your position may go up or down. But by adding a bunch of uncorrelated returns in the same portfolio, you can have you can benefit in all types of scenarios, which means diversification can allow you to essentially benefit in all scenarios. That's important, and spreads essentially allow you to do that. Another advantage is that there is a very distinct payoff for spread positions compared to outrights. The payoff profiles for spreads and the factors that drive how a spread performs are completely distinct from how an outright long versus short position would perform. Another advantage is reduced margin. This is something I hinted to previously as well, but it's very important to consider for regular traders. Margin requirements for spread trades are often lower than the margin requirements for outright trades. And that means that from a margin perspective, from a cost of capital perspective for traders, running spread trades can actually be much more viable. Another advantage is mean reversion. Spreads are often mean reverting, which means they can offer better reward to risk ratios than outright trades during late stage trades. Now, an example of this may be the gold silver ratio itself. As of right now, many of you may have seen both gold silver prices have increased massively over the scope of last year. A long position in gold or silver individually can seem a bit risky at times like this. It doesn't mean that silver prices or gold prices are expected to fall, but the reward to risk ratio can get skewed, which means that prices may fall more than they rise. Scenarios like this is where spreads tend to shine the brightest. During scenarios like this, late stage scenarios wherein the bulk of the move has already paid off, the the spread position, because of the fact that it's mean reverting, can offer advantages. The next advantage of spread trading is isolated exposure, which means that spread trades are less impacted by broader macro moves as compared to as compared to outright positions. That's useful because isolated exposure again links back to diversification benefits. Diversification benefits are very important, right? You never know when one certain macro trend may change from flipping signs from one side to the other. You never know when the dollar as a whole will start rising versus falling. As a result, isolated exposure to certain types of spreads can help nullify that risk altogether. Finally, seasonality trends. Seasonality trends is something that we're going to be exploring over the next few slides in detail. But in summary, certain assets demonstrate predictable seasonal trends, which means they rise at certain times of the year and they fall in certain times of the year. Spread trades can help you capture that shift in the form of the curve structure itself, which means how is the backwardation and contango of the gold futures actually shifting? You can capture all of that, especially for seasonal trends through spreads a lot more effectively than you can through outright trades. Nevertheless, it's not all positives, it's not all advantages, right? There are certainly risks to spread tradings. First risk is spreading risk. Spreading risk consists of the fact that correlation can actually break down. As I showed you on one of the first slide, gold and silver are actually positively correlated to one another, which means that when gold prices go up, silver prices also go up. However, when external conditions cause that correlation to break down, spreads may widen or narrow unexpectedly. That means that when that broader macro condition that was at play tends to can or rather does revert, it can cause the spread to move unexpectedly. It can cause the spread to move in a way that your initial assumptions of take profit or stop loss did not account for. Next type of risk is directional risk. This is something I also alluded to previously, but it results from the fact that there can be poor notional matching between the two legs. That means that when one of your legs is not entirely matched in notional terms to your other leg, it can leave you with a certain amount of hidden exposure. Hidden exposure is challenging because hidden exposure was not accounted for in this situation, which means that in this situation, traders were not accounting for the fact that they were planning to go inevitably long versus short, right? Because of the fact that notionals did not match, they got unintentional exposure to one of the legs. Let's look back to the gold silver ratio, right? In that case, if you just went for one contract of gold versus one contract of silver, you unintentionally assumed a short silver position. You may not have been going for a short silver position because you were always trying to express a view on long gold, short silver. As a result of that, you got your position diluted. You got your overall exposure diluted because of the hidden exposure that consisted from the fact that your notionals did not match across both legs. Another type of risk is currency risk because cross-border spreads can add FX exposure. Cross-border spreads are spreads that consist of exposure across the same asset across two different regions, right? One exposure could be in USD based Nikkei. The other exposure could be in the form of JPY denominated Nikkei. Because the fact that those two positions are denominated in different FX currencies, that can result in the fact that the spreads may diverge. That's called currency risk. Liquidity risk is a risk wherein one leg may be harder to trade than the other causing slippage. Another type of somewhat related risk is execution risk, wherein there may be a delay in entering both legs of your spread position at the same time, which can distort pricing. Finally, there's tail risk, wherein extreme events can cause spreads to behave unpredictably. Extreme events behaving unpredictably are something that we've seen very recently, right? This is an example that we saw actually about 2 months back when the conflict in the Middle East started. The spread between front month versus second month crude oil futures actually tore pretty sharply. This is a spread that tends to be very predictable, but because of an exogenous risk, it moved in a very unpredictable manner. This was a form of tail risk that played out. And in this case, it was very much a risk for spread traders because the spread position actually performed a lot worse than an outright position may have. With that overview on advantages and disadvantages, let's walk into the family of spread trades. Now, we've already covered these previously, but the reason I'm bringing these up is to emphasize the three that we'll be focusing on the most today: calendar spreads, intercommodity spreads, and cross index spreads. So, over the next few slides, we'll be giving you concrete examples on how each of these spreads may have played out if you had executed a position historically. Let's start with calendar spreads. Now, in order to start with calendar spreads, we actually have to introduce the concept of seasonality as a whole. I briefly alluded to this previously, but let's define it much more clearly now. Let's start with natural gas as an example. So what I have on screen here is the 5-year average price performance for natural gas futures, averaged year on year. And this is all indexed to the start of the year, which means at the start of the year, it's all starting at 100. If prices rise, the index rises from 100 to 110. If prices fall, the index falls below 100, right? So it's all indexed to the start of the year. And I've averaged it out over the past 5 years. That's giving us a pretty repeatable trend. That's giving us a repeatable trend for a reason. First of all, the first trend I'd like to emphasize is what we see from March to June. So from March to June, over the past 5 years, there's been a pretty consistent increase in natural gas prices. This happens because of a fundamental factor. The fundamental factor here is that natural gas prices tend to rise into summer because summer demand for natural gas is actually very high. Because there's high demand in summer, natural gas prices are pushed up because the supply remains the same. Now, towards the end of the summer, that supply tends to catch up, which means that demand tends to slow down a little bit, but supply is still increasing, right? They're still assuming that there's going to be a high amount of demand at the time. As a result of that, there can be this pullback that we've observed over the past 5 years. So, over the past 5 years, during June and July, we can see a bit of a reversal in price. We can see prices pull back. In the next part of the year, we can see that prices tend to rise once again. This happens again because of the fact that demand for natural gas is predictably higher in the winter. Because demand is higher, prices tend to head higher when supply is the same. And then when that supply finally arrives, we can see that prices pull back. So essentially, if I'm to summarize what seasonality is as a whole, it's predictable patterns caused by predictable patterns in consumption and supply. In the case of natural gas, these were predictable consumption patterns. In summer and in winter, the consumption for natural gas is high. That means that if the supply remains the same during that period, there can be a there can be a positive movement in the price. During the later part of the year, when that supply catches up, it can cause prices to pull back. This is essentially what causes seasonal trends in an asset. Now, I'd like to emphasize, or rather, materialize some of the fundamentals of calendar spreads. As I said, certain assets show the seasonal performance. This is due to predictable supply demand cycles. In the case of natural gas, it was the predictable demand cycle. In the case of agricultural commodities, it can be predictable supply cycles. Calendar spreads can allow traders to express these views on these predictable supply demand cycles in a much more reduced risk in format. Nevertheless, legging risk is a major concern for calendar spread, and with the following example, I'll highlight exactly why that's the case. Let's start with an example of natural gas. Start with a position of natural gas position in March futures, March 2026, and a natural gas position in June futures. So the spread consists of a position in both, right? We were short March futures, then we were long June futures. March futures expire on the 25th of Feb. June futures expire on the 27th of May. This trade is started, that means its inception is on the 1st of Jan, right? On the 1st of Jan, all the way to 25th of Feb, everything goes as we hoped it would, right? Between Jan 1st to 25th of Feb, all we'll see on this spread position is the outperformance of June futures relative to March futures. However, after the 25th of Feb, which is the expiry date for March futures, something changes. We lose out on that short position, which means after the 25th of Feb, that spread position converts into an outright position. After the 25th of Feb, that position, which was initially a spread, entirely becomes an outright position in June futures. And that may not have been how this view in your mind had initially started, right? You may have visualized this in a different way. But because that initial contract expired, because the March contract expired on the 25th of Feb, that position unintentionally got converted. And that's exactly what legging risk is. Now, the risk of calendar spreads during normal condition tends to be low, and that's because there are predictable movements. The predictable movements, like the ones that I showed you in natural gas in the slide before, right? The movements in natural gas tend to be predictable. That means that during those scenarios when those conditions are pretty normal, those spreads will generally move as traders hope. That's because those contracts also tend to have a high correlation to one another. Overall, that reduces the risk. However, there is a risk, and this is related to exactly what I emphasized a couple of minutes before, right? Which is that supply shocks can swing these spreads unpredictably. And most recently, we all saw this happen in March when the conflict in the Middle East started. It caused most of the most predictable calendar spreads, including WTI calendar spreads, natural gas calendar spreads, all of these very predictable calendar spreads moved in very unpredictable scenarios. This was the tail risk at play. With some understanding of that, let's delve into how traders might look at executing calendar spreads. Let's start by plotting seasonal trends in natural gas prices as a whole. 2 months I would like to emphasize on the chart here: January and April. As you can see, in January, on average over the last 10 years, natural gas prices have fallen by 5.5%. In April, by contrast, natural gas prices have increased by 6.16%, right? And both of these moves are quite consistent. That means 77% of the time in January, prices fell, and 75% of the time in April, prices rose. That means these are predictable scenarios that occur. Now, a trader might spot these. They might spot the historical trend in natural gas. And as a result, they may want to express a view on the back of this. Let's see how that view pans out. This position is expressed on the back of the same seasonal trend that we're seeing here. It's a calendar spread consisting of a position in both March futures and in April futures. So the long March position is entered at 3.122 and it's exited about a month later at 4.234. Clearly, such a position would be profitable. It was a long position and prices rose. So we can pretty trivially calculate the P&L from such a position, right? The P&L from this position would simply be the exit price minus the entry price times the contract size. Putting that all together, it gives us a profit of $10,760 for the long position. But that's not the only position at play here, right? Because our actual position here consists of both a long position in March and a short position in April. Now, the short position in April, we enter that at 3.58, and a month later, we exit that at 4.129. Because that position is also increased, the short position will clearly be loss making. As a result, your short position in this spread is actually loss making. You lose about $9,710 as a whole as a result of that short position. However, that's not all, right? Because this was a spread position, your overall positions payoff actually combines the payoff from both the leg one and the leg two, right? Your net P&L from the spread is actually still positive. So despite the fact that you made losses on the April leg of this position, they were more than offset by the profits that you made on the March leg of this position. Because March outperformed April, the spread position paid off and it was still profitable. The spread, as you can see here, rose all the way from Jan to Feb. That's the line that you see here, right? So because you were uncertain about what the directional trend on natural gas was, but you knew there's this directional seasonal trend at play here, you instead opted for a seasonal calendar spread positioner based on that seasonal spread. Uh, because of that, your risk was reduced. And despite the fact that one of those positions was loss making, your position as a whole was still profitable. That was a historical example, though, because both March and April have already played out, right? We already saw what happened. However, that doesn't mean that calendar spreads as a whole are exhausted in natural gas. In natural gas, an interesting trend that I'd like to emphasize that's still upcoming is August and December. So in August, natural gas prices have consistently increased. In 82% of the month over the 82% of the months over the last 10 years, natural gas prices have increased by an average of 8.2%. In December, they've fallen they've fallen 73% of the months, they've fallen by an average of 10%. That means this is the trend that we can still see coming, right? This is in the future. We can foresee that this trend is going to occur. In such a case, a trader could execute the same exact view that I highlighted in the previous slide, just using these new expiries. They could go long on the August expiry, short on the December expiry. The next seasonal trend I would like to emphasize is on corn, because as I highlighted previously, natural gas's seasonality is more demand driven. That means there's high demand during summer months, high demand during winter months, but during the rest of the year, there is low demand. That means that prices tend to be dictated more from the demand side. However, for agri commodities like corn, prices are more supply driven. Seasonality is more supply driven. As you can see, even in supply-driven markets, there are predictable seasonal trends. During July, there is a predictable decline in corn prices. During September, there is a predictable rally in corn prices. With that, let's construct an example trade on corn. Again, this is a calendar spread. It consists of positions in two different expiries of corn futures. The first position is a short position in corn July futures at the price of 488 cents per bushel. We exit that position about 1.5 months later at 419. Clearly, that position is profitable, and we can calculate the P&L for that at 3,450. During that same time, we did have the long position as well. Because this is a calendar spread, it wasn't a singular position we gained exposure to, right? It was both of them at the same time. So that long position, we can clearly see, was loss making. We entered that at 446, but prices fell. They fell to 417. That resulted in a net loss of 1,450. But again, despite the fact that one of these legs was loss making, your overall position was still massively profitable. Your net P&L from the spread was actually $2,000. And in this case, you did not need to know what the directional trend for corn is actually going to be. All you needed to know was that seasonally, there is this relationship between July and September futures. That means that during this period of time, July and September futures perform predictably. That's the position you expressed a view on. And despite the fact that one of those legs was loss making, you made a net profit throughout. The spread, as you can see, went down. The other sort of risk that I would like to emphasize here, because I've plotted on here both of these contracts, right, is that during the period after we exited this hypothetical trade, this trade did continue, right? It's not like the contract expired on the 23rd of June. The contract, the June contract in this case, was still active for about another month or so. Nevertheless, that contract had very low liquidity during that period. That low liquidity during that period represents liquidity risk. That means that during the close to expiry period for a futures contract, you want to avoid holding that position. During that period, the trading is actually dominated by physicals, by the spot market, which can lead to performances that are somewhat unrelated to the initial view that you were trying to provide a position on. So low liquidity can be a concern, especially close to expiry, right? This is the liquidity risk that we emphasized a few slides ago. After that, we can see the legging risk play out. Legging risk is when one leg has expired, the other leg is still active. Now you can see the spread is still moving, right? We can see the orange line up top that represents the spread that's still rising after one of the contract has expired. But if you fundamentally break down what this position consists of after this period, it's no longer a spread position. It's been converted into an outright position. That risk has turned into legging risk. This is important because clearly you want to avoid that, right? You never wanted that short view in the first place. All you wanted was the seasonal spread view. Seasonal trends in corn, again, they are not just historical, they are expected to play out in the future as well. As you can see, in September, there generally tends to be a pretty sharp rally. In July, there tends to be a pretty consistent fall in prices. So combining those two, there are still very much active trades that traders could opt to execute. These are all based on seasonal trends, right? So that's where you might start to consider calendar spreads. The next family of spreads are cross-index spreads. In this case, I'll introduce the example of S&P 500 and Nasdaq 100. In this case, we're going long on the S&P 500. We're going short on the Nasdaq 100. We're using the micro E-mini contracts on CME to express these views. So we go long MNQ, June futures at 17,539. We close that long position about 15 to 20 days later for a profit. You can see that profit of 7,708. Now, I don't have to repeat this because we've seen this in the last few examples. That's not the only position, right? We have another position. We're still short the MES June futures. However, that position was loss making, right? So putting that all together, we did make a loss on the other leg. Despite that, the net position was still profitable. The net position here still made us a profit. That's not all though, because this is where I want to start to bring back what the phenomenon that we talked about balancing notionals. Now, if we see purely on a price basis from April to May, you may observe that prices have gone up. One of the contracts has made a loss, the other contract has made a profit. But if we start to break this down a little bit further, what we'll see is that one of those positions actually had a notional value of 25,000, whereas the other position had a notional value of 35,000. In this case, it seems to have worked out for us, right? Because our long position, where we had a higher amount of exposure, was actually more profitable. It led to higher profits. That may not always be the case. What we need to do, of course, is balance that out, right? We need to balance that out by balancing the notional on both legs, which means the notional value for MES futures will need to be multiplied by 4. The P&L for the MES short would also have to be multiplied by 4. The notional value for MNQ futures would have to be multiplied by 3. And of course, the P&L for MNQ long would also have to be multiplied by 3, right? Let's see what happens when we do that. When we do that, we still see that the position is profitable. And in fact, it has yielded more profit than before. So by adjusting for the notional balancing, we have made a much higher P&L. This is important because this ensures that you never had a singular risk on one of the indices. You were purely expressing a relative value view. And despite that, you made a net P&L from the spread. With that, let's move on to intercommodity spreads. So intercommodity spreads are distinct but related assets that often move together. Relative pricing between these two assets can diverge, and that's exactly what traders want to express views upon. Examples of this can be substitutable quantities such as corn and wheat. They can also be related assets such as gold and silver. Why does this work out, right? Why corn and wheat? Why gold and silver? It's because the correlation between these two assets is high. That means they're positively correlated. And on top of that, they are substitutable. Both gold and silver are precious metals. Demand drivers for precious metals as an asset class are somewhat related, which means when traders are buying precious metals, they're oftentimes buying both gold and silver. When traders are buying agri grains, oftentimes they're buying both corn and wheat. They're substitutable between each other, right? That's exactly what these views, that's exactly one of the important effects that drives these intercommodity spreads, substitution effect. So because corn can be substituted by wheat, traders want to express views on these intercommodity spreads based on the substitution effect, based on the fact that you can replace the corn with the wheat. The other side of it, gold and silver, could be related to relative demand. At any one point, precious metals wise, traders may prefer gold over silver. That could lead to higher demand for gold versus silver at that specific point of time, despite the fact that there is still precious metal demand as a whole. Just the fact that there's higher relative demand can drive these intercommodity spreads in one direction or the other. Finally, there is cross price elasticity. That means that the price of one asset can be elastic. It can help sort of bring that substitution effect a lot closer to practical terms than it initially would have been. Because there's cross price elasticity, gold and silver prices may only move once the relative demand has sort of gone beyond that elastic limit of gold versus silver. All Putting it all together, intercommodity spreads are useful for expressing views on supply shocks in one market versus stability in another. There are a few risks in expressing views using intercommodity spreads, including the fact that correlations can weaken. As we saw, gold and silver correlation can, of course, break. We saw it break multiple times past year. Corn and wheat correlation similarly can break during certain periods. Additionally, one side may dominate the intercommodity spread. There may be times wherein there is only demand for corn, perhaps as a result of ethanol demand, right? So, as a result of that, one side may entirely dominate the movements of the intercommodity spreads, in which case the spread value is less strong. Contract liquidity can also differ. So because one asset versus the other asset are not as liquid, it can lead to liquidity risk, the same risk that we've highlighted previously for gold and silver, right? With that, I'd like to introduce in a little more detail the concept of mean reversion. Because mean reversion can actually help traders position in cross commodity spreads pretty consistently historically. Here, what I've highlighted is the gold to silver ratio. Gold to silver ratio, and I have segmented it on the basis of decades. So the first decade is 70s to 80s, 80s to 90s, 90s to 2000s, so on, right? What I've also added are the highs and the lows. The green lines are the highs and the red lines are the lows for the gold silver ratios during that decade, alongside the mean, which is the yellow line in this case. Now, as we can see, when the gold to silver ratio hit its all time high, which means when the spread reached its maximum value, we can see that beyond that, it started to mean revert. It started to go from its all time high and it started to decline. It started to head closer to its mean. The same thing happens on the other side, by the way. When the spread moves too far in the other direction, it tends to move backwards. It tends to revert back to the mean once it heads too low. Put together, these two quantities are actually very useful, right? What putting all this together is telling us that when the ratio between these two assets is moving too far from the mean, there is a tendency for this relationship to revert back to the mean. When they shift too far back from the mean, there is a tendency for them to revert back to the mean, right? This is very useful because on a long term, this is something that traders can position on the back of. And I'll be describing an example of this that you may have seen last year. In this case, it's gold and silver. We saw that gold to silver ratio hit its high for the decade. It reached 105, beyond which, through April all the way to September, the ratio reverted back to its mean, right? Let's see how a position on the back of a gold to silver ratio would have played out during that period. You had a short position that you entered on the 24th of April. You exited that on the 11th of July. That position was profitable, as you can clearly see. The P&L from that position was $9,100. You also had a long position. You exited that for a profit as well. Profit from that ended up being 29,200. We adjust for the notional, that gives us 58,400 because you would have needed two contracts of silver to balance out the gold contract. That means the net P&L from the spread was actually substantial, right? That means that if a trader had spotted back in April this view that the spread between gold and silver had actually moved to a substantially high value, they could have opted to express a view on mean reversion. They could have said that based on historical trends, when the spread moves too far in one direction, there is a tendency to mean revert. There is a tendency for the spread to go in the other direction. On the back of that, they would have expressed this view. And as you can clearly see, it was highly profitable during this period. Putting together the entire presentation, right? Because I know we've covered a lot today. First of all, spread trading focuses on relative value. That means the profits come from the price relationship between contracts and not outright direction. There are multiple categories of spread trades, including calendar spreads, intercommodity spreads, cross index spreads, each of which can offer distinct opportunities and risks. As we clearly saw, there are times when traders want to head into calendar spreads, right? When they see seasonal trends at play, for instance. There are times when you want to express views on intercommodity spreads, particularly, for instance, in the example I showed, wherein mean reversion was the view that you were expressing. Similarly, for cross index spreads, mean reversion can be a strong quantity to consider. But there's also the fact that there are different regimes under which different indices perform relative to the other. Putting that all together, there are different times to express different types of spreads. And although risk is reduced in spread trading, it's not eliminated altogether. They carry lower risk generally, but investors should be aware that there are spreading risk, there is legging risk, and above all else, there is tail risk. That's the risk that we saw play out most significantly in March, right? When a tail event occurs, it can cause spreads to move in sharply divergent directions. So with that, we can bring the seminar to a close, and I'll open the floor to questions. I can see that there's a few questions in the chat, and I can just take them one by one. Start with the first question. Yeah. So Calvin, yeah, good point, right? Calvin is asking, the gold silver mean reversion chart shown looks like the max min average are determined after it happened. Can you share a way in which we can determine max min average while we are trading real time? This is very much a real challenge that traders face, right? You don't know how far a spread can tear. Now, there is a way that traders can address this. One is methodically, which means you opt for standard deviations beyond the mean, which means that you try to observe how far the spread has shifted from the mean over the past decade. And if it's shifting beyond 2 to 3 standard deviations, you can often start to be more confident that there's going to be a mean reversion event at some point. However, crucially, that doesn't always happen. And there's a very recent example actually when that didn't occur. And that example is March of last year. March of last year, gold prices were substantially higher than silver prices, and they had been outperforming for the past several years before that. Uh, if you would just average the prior decade, what you would have seen is that it's not so easy to suggest that you may have just exited then, right? Because for several months after that, gold prices actually continued to outperform. You can phase in your entries during times like this, but it's best to wait for that move to diverge even further. It can be unpredictable, especially around the maximas and the minimas. That means that when these spreads are moving in a certain direction, they can actually move substantially. Putting that all together, right? To answer your question, how do you determine it in real time? you actually can't determine the peaks in real time at all. You can't determine when a certain ratio has peaked. But what you can determine is when the reversal has started to occur. That means that when you observe that the gold to silver ratio has started to reverse, when you start to observe that the standard deviation move has started to shift back, when there was, for instance, a two standard deviation move in the favor of gold, which is now starting to reverse, that is generally the time wherein you will start to express views on the back of mean reversion, not to preempt it as a whole. Hoping that helps address the query that you had. So, John has a question related to margin requirements. He's asking, why do you say margin requirements are lower for spread trading since you execute two contracts, each of which requires its respective margin? Case in point, gold futures and silver futures contract. Thanks for this question, John, and great question again, right? It can be a bit confusing if I frame it in the context of purely in, if you just add up both of the positions margin, it may seem like it's still greater than the margin for, the individual spreads. In this case, though, since you brought up gold versus silver, right? Since you brought up the gold silver spread as an example, I'll use that going forward. So in the case of gold to silver, the margin requirements for a gold to silver spread on CME futures offer an offset of 65%. That's the most recent scenario, and these values are always changing on the basis of span requirements. But as of today, that margin offset represents a 65% offset. Now, if I connect that back to what you're asking, right? A position that consists of long gold plus long silver should ideally consist of margin for both the long gold and the short silver, right? That means margin for gold plus margin for silver. However, the margin offset is actually 65%. That means that the margin offset is actually offering you benefits over and above just canceling out one or the other, right? The margin for the spread is actually lower than the margin requirements for any one of the outrights individually. This is not always the case, but for most of the highly correlated spreads that you'll see, these can be agricultural commodity spreads. This is more often than not the case. For gold and silver, I already highlighted that spread offset, the margin offset for that spread is 65%. For agricultural commodities, the spreads between corn and wheat, for instance, offer a 45% offset. Corn and soybean offers 55%, and corn and wheat offer 65%. So as you can imagine, anytime your offset value is higher than 50%, the offset that you're getting, the margin requirements for that spread position are actually lower than even any one of the outrights. It's not just the sum of the outrights, it's actually lower than even both the outrights individually. Hoping that provides a bit of a color on that front. Muaz had a similar question. How can spread trading reduce margin compared to the outright contracts? So in this case, Muaz, the margin offset is actually provided by the exchange itself. So because exchanges observe market behaviors over long periods of times, they know which assets are correlated to one another. As a result, for highly correlated assets, they tend to offer margin offsets. And in this case, it's probably easier if I frame this in the context of calendar spreads, because in the case of calendar spreads, those movements are actually a lot more correlated to one another. The June futures for natural gas and the July futures for natural gas are actually a lot more correlated to one another. Because those two are correlated to one another, the exchange kind of understands that, right? They understand that the positions will generally move in tandem. As a result of that, the exchange directly offers margin reduction. They offer margin offsets, which means that when you execute that calendar spread, the margin requirement for your overall spread position will be a lot lower than if you were outright going long versus short. The reason for that is because the movements in the spread are a lot more predictable and lower volatility than any one of the single outrights. I'm seeing another couple of examples, but looks like John Yip has come back with another example, yeah, right? So how does the offset work based on a specific financial example? So I think this is something that will be useful as an exercise for us to walk through. And what I'll just do is I'll open up an example on this front and just walk you through some of the maths here. For this purpose, it'll probably be better if I switch the window that I am presenting. Give me 1 second so I can just do that. So I'm hoping my screen is again visible, right? What I've brought on screen is the margin page on CME for CME Gold futures. As you can see, the maintenance margin requirement for going long or short on COMEX Gold futures is $28,313, right? Hold on, let me just open this in another tab as well so I can show you what the spread looks like. 1 second. Right. So now I've brought on screen what the margin credit for a spread position between gold and silver would look like, right? So let me sorry, just pop that on screen and just highlight it for your reference as well. So that those are these two rows, right? In this case, COMEX 100 gold futures, COMEX 5,000 silver futures, if you spread them together, you can see that the credit that CME as an exchange offers for that type of position is 60%. That means that 60% is of a credit here is clearly going to be more than the individual margin requirements for gold and silver together, right? I can probably open silver as well so that you can see what that would look like and put it into numbers. But yeah, so as you can see, one gold contract requires margin of 28,000. One silver contract requires maintenance margin of 47,000. If you put that together, right, you get 28,000 plus 47,000, which gives you 70,000 in margin requirements, in maintenance margin requirements, if you consider both of these legs active. Now, what the cross asset spread in this case is offering you is a 60% margin reduction. That means from that 70,000 of margin that would have been required to be posted for each of those individual positions, for the spread, you actually only have to maintain margin of $47,600. That's lower than the individual requirement for silver, for instance, right? So by going on a gold to silver spread, you've actually had to pose less than half of the margin requirements of each of those positions individually. Does putting numbers around that help? I'm hoping that makes it clear because I can see most of the questions were around margin offsets. So John has another question. He's asking how he can find out whether certain intercommodity spreads are correlated. Does the exchange post this correlation on its portal, for instance? So the exchange doesn't post these correlations directly, but it's relatively trivial to find this out as a trader yourself. All you need to do is find out the correlation coefficient between one asset and another. If the correlation is highly positive, it's going to be a correlated asset, right? And more likely than not, what you'll observe is that for highly correlated assets, these credits that you're observing are actually going to be a lot higher. So clearly, as you can see, different gold contracts, in this case, cleared OTC London Gold and COMEX 100 Gold, those should generally move very much in tandem, right? Both are gold prices. For that, for highly correlated assets, the credit is even higher, which means there can be a bit of that correlation that you can observe. You can observe that for assets that are more positively correlated, you'll generally see a higher margin credit being offered by the exchange. That isn't always going to be the case. The exchange doesn't guarantee that, but you can separately find out what the correlation is, and you can separately find out what the margin credit is using exchange documentation. Yes. So, John, to clarify and put it all together, right? Credit of 60% means you only need to post 40% of the combined margin value. That's exactly correct. So, the combined margin value there was 60,000. We only had to post 14,000, right? 13,300 there. So, you only have to post the 40% value. Yes.
All right. I think that's all the questions we have, and due to the time constraint, we will end the Q&A here. But please feel free to drop any more questions you may have, and we will get back to you via email. Thank you, Pranay, for the very insightful session and the engaging Q&A. With that, we have come to the end of the webinar. And like Pranay had mentioned earlier, this was the first session of the two-part series on spread trading we have with him, and we will be sending everyone the sign-up link to the second session via email as well, along with tonight's webinar recording. Thank you again, Pranay, for the sharing, and thank you everyone for your time tuning into this webinar tonight. Thank you. Sorry, that's all for this session. Thank you and have a good night.